Order blocks are one of the most powerful concepts in smart money trading, but here's the truth. Not all order blocks are created equal. Some get perfectly respected by price, leading to precise and profitable trades. Others, completely ignored by the market. Why does this happen? What separates a valid order block from a fake one? To answer this, we analyzed and backtested over 20,000 order blocks across different time frames, market conditions, and trading pairs. We identified the key patterns, rules, and structures that consistently lead to high probability setups. And in this video, we're going to break it all down for you. The fundamentals of order blocks. What makes an order block high quality? The exact conditions under which they are respected, and how you can use them across different trading environments. If you've ever felt confused about why your order block trade failed, this video will connect the dots. Let's break down how an order block really works, and the rules you should follow to spot a valid one. An order block is the last candle before a strong and aggressive price move, often created by institutional or smart money. It represents the origin of an impulsive move, where big players place their orders before driving the market in one direction. In a bullish setup, the order block is usually a bearish candle just before a strong bullish breakout. This candle tells us that institutional traders were filling their buy orders before launching price upward. But here's the key. There should be a fair value gap, a price imbalance or inefficiency right after that bullish move. The market often returns to this bearish candle, fills in the gap, and respects the order block before continuing higher. A bearish order block is the last bullish candle before a strong and impulsive bearish move. This candle marks the area where institutions likely placed large sell orders, disguising their true intentions by briefly pushing price higher before aggressively driving it down. In this example, we can clearly see how price drops aggressively, breaking a previous market structure low, confirming bearish intent. Before that drop, price forms a bullish candle, which becomes our bearish order block, the last bullish candle before the impulsive move down. Right after the drop, a fair value gap, FVG, is created, showing imbalance and strong selling pressure. Later, price retraces into the order block, respects it, and then continues moving in the direction of the overall downtrend. This is a textbook high-probability setup: structure break, fair value gap, return to the order block, and continuation. But not all order blocks play out this cleanly. In this video, we'll walk you through the exact rules you need to follow to identify only the high-quality setups and filter out the weak ones. Now, here's something important. An order block isn't always just one candle. In fact, a valid order block can be 2, 3, or even more candles depending on how price behaves. What matters is momentum and inefficiency. If multiple candlesticks show consolidation followed by a strong impulsive move, then that entire range can be considered the order block zone. Let's break this example down. We can clearly see two potential order blocks on the chart. We also see a clear break of market structure and two zones of inefficiency, fair value gaps, forming right after the impulsive move. But here's where it gets interesting. Price did not respect the second order block, and even the first order block wasn't tapped precisely. Why? Well, this is where most traders get it wrong. The true order block wasn't just that one bullish candle you marked. The correct range, the one smart money is likely watching, starts from this first bearish candle all the way to the last bearish candle right before the explosive bullish breakout. That entire zone, not just a single candle, represents the area where smart money accumulated their long positions before aggressively moving the market. So the lesson is this. Don't just box in one candle and call it an order block. Zoom out. Pay attention to momentum, inefficiencies, and where the real shift in control begins. That's how you align with institutional footprints and avoid false zones that never get respected. A lot of traders believe that an order block is respected simply because of market structure. And while that's not entirely wrong, market structure does play a role. It's not the full picture. What most people overlook is that market structure often hides internal liquidity, those equal highs, equal lows, trendline touches, and obvious support-resistance levels that retail traders love to trade from. But here's the truth. Smart money doesn't just look at structure. They look inside the structure, at what's beneath the surface. Often, before an order block is respected, price will seek out liquidity first. That means clearing equal lows or highs, triggering stop losses, and liquidating retail positions, all before making the real move. This is why price will sometimes seem to break structure, only to reverse sharply from an order block just after taking out internal liquidity. So when you're marking out an order block, don't just ask, "Did price break structure?" Instead ask, "Where is the liquidity, and has smart money taken it first?" Because a respected order block often comes after a liquidity sweep, not before it. That's how institutions trap the crowd, and that's how you avoid becoming part of it. Now, let's take a closer look at this setup and why many traders got trapped. At first glance, we can see a clear resistance level, and naturally, retail traders start selling as price taps into it. But price doesn't respect the level. It breaks through, trapping those early sellers. Then, some traders switch bias and go long on the breakout, thinking a bullish run is starting. But here's what actually happens. Price quickly reverses, trapping both the breakout buyers and the initial sellers, leaving them stuck in drawdown. Now, if we slow it down and analyze with smart money logic, we can spot a visible order block. But here's the problem. That order block doesn't have liquidity beneath it. There's no internal low, no equal lows, no stop hunt. That means smart money hasn't taken anything yet. And without a liquidity grab, the move is incomplete. But look closely. Just below this order block, we can see another, cleaner bullish order block. And above that, the current one becomes a liquidity zone itself. In this situation, the play is patience. We wait for price to sweep the first order block, take out the internal low, and tap into the deeper valid order block. Then we look for bullish confirmation, a strong bullish candle close, rejection wicks, or a break of minor structure. At first, everything looks great on the surface. We have a strong, impulsive move to the upside. We can clearly identify a break of market structure. And there's even an inefficiency, a fair value gap, confirming that smart money might be involved. So, we mark out the bullish order block, and we spot a bullish candlestick closing within the block, a typical confirmation trigger. At this point, everything seems to follow the rules. So, we pull out the risk-to-reward tool, set up our long position, and enter the trade. But what happens next? Price moves forward, and instead of going up, it drops lower, hitting our stop loss. So, what went wrong? It's simple. We traded without identifying where liquidity lies. Even though the structure looked clean, there was no internal liquidity sweep, no stop hunt, no equal lows taken out, no evidence that smart money had cleared the field before pushing higher. The market simply wasn't ready yet. This teaches us a key lesson. First, notice how price sweeps the sell-side liquidity, creating what looks like a break of market structure. To many retail traders, this would signal a potential trend change. Now, if you were watching closely and identified these two bullish order blocks, you'd be on the right track. But there's a key detail. The first order block fails to hold. Price trades below it before closing bullish. That's not a clean confirmation. But then, on the second order block, price gives us a proper bullish close, signaling that the upside move is valid. And sure enough, the trade moves into profit. But smart money isn't done yet. Right after that, price creates another liquidity pool, both on the buy side and the sell side. They're hunting for more liquidity, building up stops above and below to trap more traders. Now here's where things get interesting. If we look deeper into the current price action, we see a few critical signs: a break of market structure, an internal liquidity sweep, a closed fair value gap, and a clearly defined bearish order block. So what's the smart play here? We wait for a bearish candlestick to close inside the order block, and that's our confirmation to enter short. Target: the previous sell-side liquidity or low. But let me ask you this. If you're currently holding a buy, are you still confident in it? Pause the video right here and drop a comment below. Let me know if you're holding or flipping your bias. And of course, make sure to subscribe to the channel because I'll show you the result of this setup at the end of the video. We can clearly spot a valid bearish order block in this area. We also see a massive impulsive move to the downside, creating not one, but 3 fair value gaps. On top of that, we get a clean break of market structure. Everything seems to align. At this point, the logical next step is to wait for an internal liquidity sweep, then a retest of the order block, and finally, a confirmed entry. But what happens instead? Price doesn't even come back to the order block. It just continues to drop further without ever offering us a chance to enter. This is where many traders get confused or frustrated. But here's the truth. Not every order block will be respected. Even smart money knows how we use these concepts, and they adapt. We're not the chosen ones just because we understand smart money. We're simply trying to follow the real market movers, not fight them. So what really happened here? Smart money likely saw enough liquidity already swept internally, enough inefficiency filled, and didn't need to return to the origin of the move. In some cases, momentum takes over, and the market continues without a textbook pullback. We can clearly spot a valid bearish order block in this area. We also see a massive impulsive move to the downside, creating not one, but 3 fair value gaps. On top of that, we get a clean break of market structure. Everything seems to align. At this point, the logical next step is to wait for an internal liquidity sweep, then a retest of the order block, and finally, a confirmed entry. But what happens instead? Price doesn't even come back to the order block. It just continues to drop further without ever offering us a chance to enter. This is where many traders get confused or frustrated. But here's the truth. Not every order block will be respected. Even smart money knows how we use these concepts, and they adapt. We're not the chosen ones just because we understand smart money. We're simply trying to follow the real market movers, not fight them. So what really happened here? Smart money likely saw enough liquidity already swept internally, enough inefficiency filled, and didn't need to return to the origin of the move. In some cases, momentum takes over, and the market continues without a textbook pullback. All right, traders, before we wrap up, here's the result of the previous example. Those who were holding that buy, you're likely out of the market by now, either in profit, closing because you saw another setup, or you were stopped out at break-even or your stop loss. But for those who executed the sell setup based on the confirmation, congratulations! You followed the structure, respected liquidity, and aligned with smart money. At the end of the day, remember this: future price action is always the final confirmation. No bias, no guessing, just pure reaction to what the market reveals. I hope you found value in this breakdown and learned something powerful today. If you enjoyed the video, make sure to like, comment, and subscribe for more smart money content. I'll see you in the next one. Trade safe, stay sharp, and stay disciplined.